Opportunistic hedge fund strategies seek to profit from broad market dislocations, macroeconomic trends, and unique investment opportunities that arise across asset classes and geographic regions. Unlike more narrowly focused strategies, opportunistic managers have significant flexibility to allocate capital among equities, fixed income, currencies, commodities, and derivatives. Their investment decisions are often driven by economic forecasts, policy developments, market sentiment, and valuation anomalies. Because these strategies are not constrained to a specific market segment, they can adapt rapidly to changing conditions. Successful implementation requires strong macroeconomic analysis, active risk management, and the ability to identify opportunities before they become fully reflected in market prices. Global macro strategies are among the most prominent opportunistic approaches. These strategies seek to capitalize on anticipated changes in economic growth, inflation, interest rates, exchange rates, and government policies. Managers may establish long or short positions across multiple asset classes to express their views on economic developments. Trades can be discretionary, relying on manager judgment, or systematic, using quantitative models to identify opportunities. Because global macro funds can profit from both rising and falling markets, they often exhibit low correlation with traditional investments. However, their performance depends heavily on accurate forecasts of complex economic and political events. Specialist hedge fund strategies focus on highly specific market segments, industries, or risk factors where managers possess specialized expertise. Examples include volatility trading, reinsurance, commodities, intellectual property investments, and niche credit markets. Volatility strategies, for example, attempt to profit from differences between expected and realized market volatility, often through options and derivatives. Specialist managers seek opportunities that may be inaccessible or poorly understood by traditional investors. While specialized knowledge can create significant competitive advantages, these strategies may also involve concentrated exposures, limited liquidity, and elevated operational risks that require careful monitoring and due diligence. Multi-manager hedge fund strategies, often referred to as funds of hedge funds, invest in a diversified portfolio of underlying hedge funds rather than directly managing individual securities. The objective is to improve diversification by combining managers employing different strategies, investment styles, and risk profiles. By allocating capital across multiple hedge funds, investors may reduce manager-specific risk and gain access to a broader opportunity set. Multi-manager structures also provide professional manager selection and ongoing monitoring. However, they typically involve an additional layer of fees and may reduce overall returns. Consequently, investors must carefully evaluate whether diversification benefits justify the added costs. Factor models provide a framework for understanding the sources of hedge fund returns. Rather than attributing performance solely to manager skill, factor analysis decomposes returns into exposures to systematic risk factors such as equity markets, interest rates, credit spreads, volatility, liquidity, and momentum. Some hedge fund returns can be explained by these common factors, while the remaining unexplained portion is often referred to as alpha. By identifying factor exposures, investors can better understand portfolio risks, evaluate manager performance, and determine whether returns reflect genuine skill or simply compensation for bearing systematic risks available through other investment vehicles. Hedge funds can significantly influence overall portfolio characteristics by enhancing diversification, improving risk-adjusted returns, and providing access to alternative return sources. Because many hedge fund strategies exhibit lower correlations with traditional equity and fixed income investments, they may improve portfolio efficiency when incorporated appropriately. However, investors must also consider potential drawbacks, including higher fees, leverage, liquidity constraints, operational complexity, and transparency limitations. Effective portfolio integration requires understanding both the factor exposures and unique risks associated with hedge fund strategies. When selected and monitored carefully, hedge funds can serve as valuable components of a diversified investment portfolio and contribute to long-term investment objectives.